Hi there. What is the best time to buy or sell stocks or shares in the stock market? This is an important video for you because timing and strategy is everything in the stock market. Stock market doesn't reward emotions. It rewards appropriate timing and strategy. That is why, by you understanding the best time to buy or sell stocks in the stock market, you're going to have the knowledge necessary to assist you take amazing positions in the market. And in this video, I'm going to look at this in three parts, whereby the first part, I'm going to examine from the lens of a person who's new starting their investing journey. And then the second part, I'm going to look at it from the lens of a person who is already in the stock market. They are looking to maybe strengthen their position or even make adjustments to their investment. What is the best scenario for that person to buy? And then the third part, I'm going to look at a scenario where an investor is looking to exit the market. What is the best time to sell? By the way, in case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about investing and making money each and every day. If those are the kind of topics which you like, down there there's a button called subscribe. Click that button, consider subscribing to this channel, and while you're still at it, drop a like on this video. Thank you for subscribing and also liking this video. Before I even jump into it, you as an investor, why do you think is the best time to buy or sell stocks? Comment down below. I want to hear what you have to say, even as I discuss this. So, on to the first part. Assuming it is a very new investor, completely new, what is the best time to buy? For a new investor, I'd really tell them, get in. You don't have to select the best time to get in because the truth is that you don't have experience when it comes to investing. You haven't bought stocks before, okay? And some of these things relating to investing, you can only learn them through experience. That is why buy as soon as you are thinking about investing and then start learning as time goes by, okay? And then the second thing is that in the initial phase of buying stocks, you're going to have bought the first one. Maybe you want to buy the second one, third one, you name it. I think when someone is starting out, maybe if they want to build a portfolio, having somewhere between 5 to 10 stocks in their portfolio is a good starting point, right? But then again, don't build your portfolio blindly. That is why after you buy the first stock or the first share, which of course we just bought to get started, the second one, continuing to the 5th or even the 10th, you need to buy quality stocks. What do I mean by quality? A quality stock is the one where you've already done fundamental analysis to understand what you are getting into, not just buying blindly because you saw, for example, the price dipped. Do analysis and then buy stocks from quality companies. Start by first of all understanding the companies you want to invest in before you even buy their stocks. Don't buy a ticket, buy a business, okay? And talking about that too, only add stocks to your portfolio in case they are contributing to diversification. Don't just stack stocks or shares from only one company or one sector, okay? Because through that, you won't be really reducing your risk. What if the sector is impacted? Case in point, at an Nairobi Securities Exchange, if you put all your shares or all your stocks in manufacturing, these companies in manufacturing, maybe they are seeing bad things, okay? You need to diversify. Maybe some of your stocks have them in manufacturing, some in agriculture, some in telecommunication, others in banking, you name it. These are just examples I'm giving you. I'm not saying you buy in those sectors. Do your study, do your research before you buy. And then the last tip for a beginner when they're looking to buy shares or stocks, only utilize money which you won't be needing in the immediate near future. I remember a case, it was about 2 months ago. Someone really surprised me. They did buy shares like today, and then they were ready to cash out because there was a little appreciation on the share, they were looking to cash out barely 1 week later. That is not investing, that is gambling. And that is the easiest way you'll end up losing money in the stock market. Remember, as I've said, the stock market doesn't need emotions. It needs a person to invest and stick to their strategy. So only put money in the stock market, the money which you won't need in the near future. Because if you need it in the near future, maybe even put it in the MMFs, okay? And then the second part of this video is, assuming you're already an investor, right? You are thinking about continuing to grow. What are some of the things you need to consider as you are buying your stocks or adding to your portfolio? The first thing you need to consider is the broad market dips. What do I mean? Out here people say buy the dip, but then again you need to be quite tactful on how you are buying the dip. Most at times, the broad market dips are okay because chances are those underlying securities, those underlying stocks are going to recover. And that is proven in history. Markets do crash and also they do recover. So when there's an opportunity of broad market dips and you've also done your own analysis, you believe in a given stock, don't hesitate, jump in it, okay? And then the second opportunity for you to buy a stock is after you do your own technical analysis and fundamental analysis. Of course, you can detect trend analysis from just looking at the share prices, okay? But for you to detect the true intrinsic value of a company, for you to know whether it is undervalued or overvalued based on different parameters, you need to include fundamental analysis. If you see a company is undervalued, that is an opportunity for you because the price correction, once it starts correcting its price to include the intrinsic value, chances are the price is gonna go up, resulting in share price appreciation. So look for those companies which are also undervalued based on your analysis, and those could be good candidates to add to your portfolio when you are looking to buy more stocks to add to your portfolio as you are growing after passing the first phase, okay? And then another thing you need to look at is that when you are looking to buy as a seasoned investor, stay ahead of the game, okay? There are typically major events out there, which most at times people hear about them on the news. But you can be researching about your company, even looking at their websites, okay? Looking at the companies which are listed in your stock exchange on their websites for you to understand major events, okay? To understand what the news says and make an informed decision. And I'm saying so because most investors out there react blindly to news. Case in point, maybe there's news about a company holding a given event and speaking very positively about a business they're intending to do. Most people jump on buying that particular stock at a particular point in time. That is not the best time to buy because most at times the people who are buying at a particular point in time are noise traders. And unfortunately, 95% of the market consists noise traders. That is why you need to take some time, even 1 week, 2 week. Sweet spot is somewhere between 2 weeks to 1 month time for you to gauge if that stock was actually being pumped up for no reason or it is anchored on solid business prospects. That way you'll be able to make informed decisions other than just reacting on news, okay? And then the other tip for you as a seasoned investor when you're looking to buy is that remove emotions from your purchase decision. That is why it is useless to wake up every morning to look at the stock market and say, I think this share has increased, I can buy. You can utilize simple techniques like dollar cost averaging for you to even have a consistency of slowly increasing your holding in a given stock or even expanding your portfolio. You can, case in point, say each and every month you're going to be buying shares or stocks worth 20,000 Kenya shillings. You do that consistently, over time, emotions will be out of the equation. And even if you're going to be averaging up as you buy, chances are, based on every study you've done, analysis, whatever you add to your portfolio is going to contribute positively to your portfolio. That is dollar cost averaging. Basically, pumping a given fixed amount of money each and every time to ensure you grow your portfolio or you add more stocks in a way that's sustainable. And then the last tip for an investor out there who has already passed the initial starting phase, their midpoint, is that ensure you review your portfolio before you just jump on any buying decision. And the sweet spot for this is you could be reviewing maybe every 6 months or even annually, and then deciding which stocks to drop, which ones to add. And that is important because with such kind of like timelines, it allows you to be objective. And most importantly, it also allows you, when you are doing this particular analysis, you are very comprehensive. Because if a stock is not serving you, you might need to change it to another stock, which based on your analysis might serve your purpose. And then talking about that, the third part of this video is for a scenario where you are looking to exit, it's time to sell. And the first signal for you that it's time to sell is when a company is no longer serving your purpose. Maybe because you're not aligning on values or objectives. That by itself is a very strong signal indicating that maybe you need to let go share or stock of that particular company. Because I also believe beyond just chasing the numbers in the stock market, you are investing in a business. You are becoming part owner of a business. So if it isn't serving your purpose, basically not aligning on values or objectives, it can be quite a tricky situation for you. You'll be conflicted. And that by itself is a signal. Maybe you need to let go of that particular stock because it is no longer serving your purpose. And then the second signal or tip for you is that you can exit when analysis shows the business has become fundamentally weak. Remember, I told you there are two things. People out here typically look at the charts. That is technical. You are looking at the trends and so forth to guesstimate. But the fundamentals are the ones which truly anchor the health of a business, anchor the intrinsic value of a business. So if the fundamentals have become weak, case in point, the company is wallowing in very huge debts. Management is having very high turnover. The business doesn't have specific competitive advantage. That can get tricky. And those fundamentals, you shouldn't ignore them. Because it is like a vehicle which is already telling you it has mechanical challenges despite you repairing it. It is constantly having mechanical challenges. You need to exit that vehicle, stop using it before it crashes your life. Simple as that. And that is an important thing which a number of investors out there do ignore. And then the other thing is that don't hold a dead horse just because it is in your portfolio. Guys, I know when you are starting out and also when you're midpoint your investing journey, sometimes you get very attached to specific stocks, okay? To the extent that you find it difficult to let go. But at times it is good to let go because you holding a dead horse is gonna bring down your return of your portfolio, okay? And then the other opportunity where you have the chance and you are justified to sell is when there is an alternative capital allocation which is needed, which is superior to your holding. Case in point, maybe one or two stocks in your portfolio over the past 2 years have been having an average appreciation of maybe 2% on their stocks, and even are not paying you dividends. In case you are looking, for example, alternative investments out there which are superior, maybe treasury bills, treasury bonds, which are paying maybe even 10, 14%, that way you are justified to release some of those stocks so that you can unlock the capital and invest in a superior investment opportunity. If a company is wallowing in debts, you've done debt ratio analysis. Based on fundamentals, it can't save itself. Who are you to save the company? You are giving the company money to use it for business, and you're gonna enjoy some returns. If the company is wallowing in debts, you're most likely gonna end up losing your investment. Those are justified scenarios which you can utilize for you to be able to sell stock or share of a given company. Because if you don't, you're gonna find yourself in poorer position. Guys, what do you think about this video? Do you think these are tips which you can utilize to decide whether to buy or sell a stock of a given company? In case you have other ideas or other tips, comment down below in the comment section. Let's continue discussing. Cheers, guys, and I look forward to share with you other amazing videos next time. Take care.